Hello everyone, welcome to today's US Open live session. 10 minutes before Wall Street opens. It is Friday, February the 9th. I am your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. Today, we saw just earlier the US inflation revisions, which did not offer any upside surprise as markets feared going into this release. And this creates some volatility and some pressure on the US dollar. We also had standing out, we had the International Monetary Fund urging the Central Bank of Japan to exit its ultra loose policy setting. So we will be focusing on USD JPY today. And we're also going to talk about key incoming inflation data next week, a hot week from the UK and the US. These are some of the main themes of today's session. However, before we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please read carefully through the risk warnings and the disclaimers. I'll give you a few more seconds to do that, and then we will begin. Okay, let's get the ball rolling. As I mentioned, we had the US inflation, CPI inflation revisions earlier, and that created some volatility and pressure on the greenback. We're going to start with that. Then we're going to focus on USD JPY because we had some commentary from Bank of Japan officials and from the IMF calling on the Central Bank of Japan to exit its ultra loose policy setting. We're going to cover, as always, the euro dollar and the Nasdaq. And then we're going to talk about next week's key releases, UK and US CPI inflation, mostly at the start of the week. So let's go ahead and talk a little bit about the revisions today for the US CPI inflation. Going into this release, markets were fearing a potential upside surprise and an upgrade in the previous figures. That did not happen. If anything, we saw some lower numbers. The December monthly headline CPI was adjusted to 0.2% from 0.3% previously. So that pointed to this disinflation trend, and that puts pressure on the US dollar again. It was mostly, it didn't offer any surprises. That was good for markets because they were fearing upwards adjustment, which did not materialize. However, I don't think that this can massively move the dollar, especially ahead of next week's normal releases. Now, let's move to the USD versus the Japanese yen, which is in a position of strength. It runs its second straight profitable month and gains this week due to the repricing around the Fed's policy path. We have already discussed that extensively. As officials pushed back against market expectations for a March cut. Furthermore, last month, the Bank of Japan maintained its ultra-loose setting and remained committed to easing and did not show any inclination for any immediate changes. Of course, let me remind you that the Bank of Japan is on the other side of the policy spectrum, ultra loose policy setting with asset purchases, with yield curve control, and with negative rates, and tries to see inflation moving up sustainably, exactly the opposite of what most major central banks do, including the Fed. Now, given these latest developments, the pair extended its gains and keeps the 152.2 handle in its crosshairs, which is the highest level in nearly 34 years. On the other hand, however, we must say that it had failed to clear this level back in November. And again, on the technical front, if we take a look at the relative strength index at the bottom of the chart, you can see how it is on overbought territory. You can see that here around the 70 mark, which is generally considered as overbought territory. Of course, it has been more of an overbought recently, so there's probably room for such conditions to develop further. Now, we also need to say that the Fed, despite this pushback and the moderation expectation, the Fed has clearly pointed to lower rates this year. Markets continue to see multiple cuts despite the moderation we talked about in pricing, while its Japanese counterpart has hinted at an eventual normalization of its policy and appears increasingly confident it will achieve price stability. We had some comment yesterday from Deputy Governor of the Bank of Japan, which, although we can hardly say that his comments were hawkish, but they definitely heightened chances of a pivot. He said that if sustainable and stable achievement of the 2% target comes in sight, that's the crux for the Bank of Japan, the policy setting would have fulfilled its role, and officials will explore whether it should be revised, meaning a change in course. And adding to the above, the International Monetary Fund today urged the central bank to abandon its asset purchases and yield curve control now, while gradually raising short-term policy rates thereafter. So these factors, along with these technically overbought conditions, can create renewed pressure, and I wouldn't be surprised to see another breach of the exponential moving average, currently located at around 145. But the downside appears well protected with the daily Ichimoku cloud. We're not for our chart, but this is the daily Ichimoku cloud, which spans towards 143. All in all, I would say that USD JPY is one of the pairs with the most potential for repricing towards the downside, because it has seen massive rally over the last couple of years due to this extreme differential between the Fed and the Bank of Japan, which has favored, of course, the greenback. So now both banks are looking to change tack. The Fed is looking to cut rates, whereas the BOJ is looking to raise them. But so far, we haven't seen this happening. Now let's go to the euro dollar. Again, it's been an uneventful week essentially for the pair after the big movements of last week, the known factors that we talked about. It did find support at the December lows as we expected. And given the Fed's pushback for rate cuts, it may get the chance to reclaim the 200 period EMA at around 1.085, but it does not inspire much confidence because the ECB is also looking to cut rates, although it is more hawkish than its US counterpart. But in any case, we see the need for a significant catalyst for moving further higher and challenge the 1.010 handle. Now, the immediate bias is definitely on the downside, and the pair is exposed to the 76.4% Fibonacci of the last leg up, but again, sustained weakness does not look easy. As we have said before, bias is on the downside, immediate bias, but it lacks firm direction because there are some competing factors in play here. What will it take to jolt it? Probably next week's CPI inflation from the US, which we're gonna discuss in a little bit towards the end of the session of our session. First, let's go to the Nasdaq 100. Again, not much has changed here. As we have said, the tech-heavy index has largely overlooked at this pushback from the Fed, partly helped from mostly strong tech results from the United States. We covered the earnings heavily, tech and otherwise. We talked about Disney, we talked about Ford, and we also talked about ARM Holdings, the chip yesterday, the chip designer that had one of the biggest IPO of last year, initial public offering, and now trades at more than double than its initial price. And this helped the index move towards the 18K handle. I would say the next resistance would come at close to 18,300. But on the other hand, overbought conditions are a pullback, but a move below the exponential moving average at around 17.14, I would say. It would need definitely a strong catalyst. It is a high bar. Of course, if that were to happen, that would endanger the bullish momentum. And with that said, let's turn to some key events coming up early next week. It's a hot week, mostly inflation. So let's start with the UK. We expect the CPI inflation there on Wednesday. It has more than halved from its October 2022 multi-decade peak, as you can see on this graph here. But it's paused this decline by moving slightly upwards in December at 4%, and the first increase of the past year. However, it remains above the 2% target, and the central bank does not expect it to hit the 2% target. You can see that there is still some distance. And the central bank does not expect to hit target for at least until the end of 2025. So definitely a long road. The central bank, we talked about that, stood pat last week and hinted at peak rates, removing the previous reference for further tightening if necessary. But it called for sustained restrictive stance and needs more evidence before lowering rates. Markets view this starting in May, June with 4 or 5 cuts. Governor Bailey did not say anything against that, but it does seem a bit far-fetched to start as early as May, at least as things stand now. Of course, a day earlier on Tuesday, again from the UK, we have the paid data, which have shown moderation again recently, similar to inflation, but remain historically elevated. Wage growth was at 6.5% the last print, and this feeds a wage price spiral, making much harder for the central bank to control inflation. That has been a constant headache, but again, we're seeing easing there as well. And we also expect the US CPI inflation on Tuesday. Significant progress has been made here. You can see from the summer 2022 multi-decade highs how it has been coming down. But over the past several months, we have seen some persistence and an increase to 3.4% in December. So more work may be needed. Again, some distance here until the Fed's 2% inflation target. The Fed has said that it needs greater confidence that inflation is moving sustainably towards that goal before it moves on rates. Of course, any further signs of stickiness would raise the bar for a pivot. Chair Powell, as we already said, had put cold water on hopes for a March cut, and now markets see this happening in May the earliest. So that's pretty much it from me for today. Again, major events coming up next week, mostly US and UK inflation. We gave a preview today, and we will be looking at the incoming data. Thank you for joining me. We will talk again on Monday at our usual time slot every weekday, 10 minutes before Wall Street opens. Thank you.